Hey guys, it's that dividend guy coming at you with another Robinhood investing video with another dividend portfolio update. So today we're going to look at the overall portfolio performance. We're going to look at the dividend that I got paid today. We're going to look at the individual holdings. We're going to look at the watch list and what stocks I would and wouldn't buy at current prices. And then we're going to look at my portion of the portfolio for growth. So we're going to look right now at my overall stats. So for today, we are up about $23. For the week, we're down 610. For the month, we're down 1190 or 1091. The 3 month mark, we're down 14, almost $1,500. For the year, we're down 4080, and all time we are up 329.04. So most bank accounts right now are yielding about 0.5, 0.6%. So even though there's a lot of fluctuation, even with the pandemic hitting, my portfolio is still making me 1% more than I would make in a traditional savings account. And keep in mind, this doesn't include dividend payments, so the line is a little skewed, but this is my argument for the stock market. Yes, it fluctuates. Yes, you can lose and gain money at any time, but over the long term, it goes up. And keep in mind, this is after the pandemic, like bashed my portfolio. I was up to nearly 23K. So if you add $3,000, you know, that's going to help the percentage. So that's my main argument there too is look, we were up past 23K. We were up 12%. That is significant considering that it's almost 12.5. So we made 12% versus 0.06 that you get in an Ally bank account. So that's the real percentage. That's the real amount of money I have in this account. It's 23K. It's not 2000. It was 23 before the pandemic hit. So you have to keep in mind that that money is still in there. It's just not properly valued, right? So we're down 3K. It's not a huge deal. It doesn't bother me. I don't lose sleep over it or anything like that. But keep in mind, we went from a 12% return, which is better than the S&P 500 does annually, down to 1.61. But I don't know how the S&P has been affected. I do know the FANG stocks are really pushing it higher, um, but I'm happy with I'm happy with even a 1.6% um, return on my money, given the environment we're in and the fact that it was actually 12%. So, anyways, guys, let's take a look at the dividend because that went up. We got paid $1.06 from um, FRT today, and we're also going to get paid by Realty Income as well. So we're going to add another $3 to that. So that's about 16 bucks or so that we're going to get and just sitting in buying power, which it accrues interest. So I'm going to leave it in there and see if it probably won't help us buy another share of ExxonMobil because keep in mind we bought PBCT. So next month, November is going to AT&T and ABBV are going to pay us, and that money is going to go towards ExxonMobil at 35. So we get paid about $140. So we have enough for 3 shares. I don't think that's enough to get us 4, but even if it's not, it can just sit in there and keep accruing. It's not a big deal. So first, we're starting with a quality REIT, quality dividend aristocrat too. My favorite real estate stock being Realty Income, ticker symbol O. We have 15 shares, $907 of market value. Average cost is $45.38. We have 4.37% of the portfolio in Realty Income stock. We are up $227.10, up 33% on Realty Income. And as I said before, we do have a dividend coming in for this month, $3.51. Keep in mind, guys, the reason I'm such a big fan of this company is how they structure their business and that they pay monthly. They're advertised as the monthly dividend stock. So this company pays me over 35, probably close to $40 a year. So that's awesome. I know $3 a month doesn't sound like a lot, but that does compound. That's half a share for my current a year for my current investment, and I plan on adding to this. I'm hoping that I could get like something close to like a $30 dividend. So with other stocks, I could buy shares of my goal stock of like AT&T. Say I wanted to buy like 3 or 4 shares of that. Any extra cash that I have, any leftover dividend money, I do want to put into Realty Income. I know I could do fractional shares, but it drives me crazy. I have like minimal OCD about like the numbers not being even, so it's not worth it. But that's the goal, is to make Realty Income one of the totems of the portfolio, one of those foundational stocks, because I am a big fan. I like the business model, and I like that they pay monthly. Next, we have Altria. We have 149 shares. I really want to get that to 150. But we have $5,900 of market value. 43.61 is our average cost. About 28.5% of the portfolio is in Altria. That will be going way down because Coca-Cola is my main focus. And so that will really push the percentage down, and I won't be over allocated. There are a couple stocks in the portfolio that I am very over allocated in, but there's a reason for that. They pay really good dividends, and I wanted to be focused on the most efficient payers because I'm already dividend efficient in every single one of those stocks. So that's the method behind the madness there. I know I'm down 582.63, down about 9%. I don't lose sleep over it. As you guys saw, I got paid $128 from Altria. So with that dividend, throughout the year, I'm close to break even, because it'd be 480 something dollars. So I'm really only down like $100 when you include the dividend payments I'm going to get this year, and that's just on like right now when it's down near my at 43. I could break even at like $40 with the dividend that I have right now. So that's a cool way to look at it, because the thing is the dividends don't get factored into your total return, not like that anyway. So if you add the dividends that you're paid against how much you're down in the stock, it really means I'm only down about 120 bucks. Next, we have Coca-Cola, my goal stock for this set of months. I'm a huge fan of Coca-Cola. I have 20 shares, about $1,000 of market value. Average cost is $51.26. About 4.8% of the portfolio is in Coca-Cola. That will be going up. I'm a huge fan of the Coca-Cola company. It's one of my favorite holdings. The only reason that I didn't pick Coca-Cola over Altria is because Altria has the same status and it pays more than double the dividend. So the goal was originally was to use Altria to funnel that dividend money into Coca-Cola, and with $128 I can buy almost three shares of Coca-Cola every month that Altria pays me. But that doesn't work with my strategy. So the thing is, I would have to have a stock like ExxonMobil paying me like $150, and then I could buy three shares of Coca-Cola, because of how the payments work, because ExxonMobil funnels into Coca-Cola stock. So Altria being able to buy three Coca-Cola doesn't really help me, because then I have to wait 3 months for that money to be in the market, that dividend payment to be added, the dividends to be added for the next month. So with my strategy, it makes sense. ExxonMobil would actually have to have enough cash to pay for Coca-Cola. Next, we have FRT. They paid us today. We have one share, a 76.18. We have $113.40 for an average cost. That will go down in the future. We have 0.37% of the portfolio in FRT, down 37.22, down 32.82%. Not super worried. I do like the way they structure their business. I like the specs that they use, as in I like where they have placed their malls, and the average income, the amount of people that live around there, the amount of traffic that they're pretty much guaranteed by putting it in the right place, and the array of tenants that they have. They have such a great tenant mix. I really do want to add more of this company in my portfolio. It's just I'd rather own Realty Income, because I'm not a huge fan of malls, and I know Realty Income is kind of retail, kind of in the same space, but I do like that they have more diversification than FRT does. So that's why Realty Income is ahead of them, but I do want a pretty sizable position in FRT. Next, we have Lowe's. We have two shares, about $353 of market value. Average cost is $100.86. 1.7% of the portfolio is in Lowe's. We are up $151.24, up almost 75% on Lowe's, which is crazy. Sadly, I do have my money, quote unquote, tied up in this stock, because as you can see, my average cost is about $101, $101 now. So I'm up about about $75 right now, $74 a share. Wish I would have bought more Lowe's at the price I did. But I think this was actually dividend money, so I'm not sure if I bought it with it was probably a buy of like AT&T, right? And I didn't have enough AT&T or something, or maybe I don't remember when I bought it, but I wish I would have bought more of this quality dividend king. Then we have AT&T. It's my gold stock for the set of months. One of my favorite dividend payers. Just a fat dividend. Great dividend growth history. I know the business in the past has been kind of shaky. I know the stock is kind of flat. Honestly, it's gone down, but that's a good thing for dividend investors. I don't have an issue with a stock trading flat. I'm not in this for appreciation. So, I mean, if the company, as long as the company grows its revenue, I don't care about the stock price. I care about the revenue, about the amount of money the stock brings in. And as long as they have enough cash flow, free cash flow, to cover the dividend and increase it, even if it's like by 1 or 2%, that's my focus. So I never care about whether a stock goes up or down. I don't lose sleep over that. I don't lose sleep over the volatility of my portfolio. What I care is buying quality companies that can pay me increasing dividends year over year, so I get paid more every year that I hold them, and AT&T can do that. So I have 126 shares, almost $3,500 of market value. Average cost is about $30 per share. 16.7% of the portfolio is in AT&T. This is going to be a massive position. I love the business model. I love the consistency of the telecom side of the business. I am a huge fan of Warner Media content. Batman, which includes Joker, Wonder Woman, Superman, Looney Tunes, Harry Potter. Just so like they honestly, to me, I know Warner's not Disney, but they're second place for me. I like them more than Comcast and stuff like that. I like their products. I like their characters, their copyrights, that type of thing more. So I think Warner was a phenomenal acquisition. In fact, I looked at it as a dividend play that I liked better than Disney. So I wanted to buy Warner before it was bought by AT&T, but I didn't get a chance to do that. But I am down on the stock overall, but that doesn't bother me because, as you can see, I have a dividend coming in of $65. So with that dividend, so 612, it's about 200. Sorry, more than $200 is going to be paid, about 240. So technically, I'm not really down that much. It's more like I'm down $15 if you use the dividend, the annual dividend, to cover my total return. I'm almost break even. But the reason I'm happy that I'm down is because, as you guys probably remember, oh sorry, I forgot. I have airplane mode on. But AT&T was like at $38 a share, almost $40 a share. So $27 is phenomenal. It's a great price, especially for me, because look at that $29 average cost. If I was working right now, I'd be pouring money into AT&T. And I do have a dividend, and that dividend will go towards ExxonMobil stock, which right now, at the price that it's at, that's about, I think, around 1.5 shares. And the reason I'm excited about that is because ABBV as well. Oh, sorry, I'm used to ABBV being there. I forgot PBCT is. Next is PBCT, a dividend aristocrat. That's a bank. 13 shares, $138 of market value. 1080 is our average cost, so we are down a little bit, but I'm not worried about it. 0.66% of the portfolio is in PBCT, and we're down $2.34, down 1.67% on PBCT. Not super worried about it. But next we have ABBV. We have 60 shares, $5,100 of market value, 72.22 is our average cost. About 25% of the portfolio is in ABBV, and we're up about $789, up 18% on ABBV. They have not announced their dividend yet for next month, but I know unless there's a dividend increase, it's 70.80. So with ABBV, with PBCT, with Lowe's, and with Realty Income, so I have 4 stocks that pay me. I have a little bit over $140 of dividends coming in, and that is going to pay me next month, right? Or sorry, that's going to be used to pay me next month, to increase my next month's payment, which will be ExxonMobil. And so I have $140, so it's sitting about like $40 a share right now, right? So So one share is 40, 80, 120. So I have locked in now at the current price of Exxon, as long as it stays around that $40 to $42 range. I can now buy 3 shares of ExxonMobil every single month. So to catch you guys up, um, Altria pays for 4 shares of AT&T. AT&T and ABBV pay for 3 shares of ExxonMobil, and ExxonMobil with the other dividends is about $90, which is enough to buy 2 Altria shares or 2 CocaCola shares. So I have 2 for the first set of months to reinvest. I have 4 AT&T shares, and I have 2 shares of Altria as well. So it's really starting to add up, guys. Being dividend efficient in one stock is great, but being dividend efficient in a stock that can buy you multiple shares of one company, or multiple shares of different companies, is great. Next, we have J&J. On to the last set of months, we have 2 shares, about $300 of market value. Average cost is $135.79. 1.42% of the portfolio is in J&J. We're up 22.92, up 8.4% on J&J. Next, we have another dividend king. We have 3M. We have 2 shares. 338.16 is our market value. Average cost is 147.28. 1.63% of the portfolio is in 3M. We're up 43.61, up 14.8%. Then we have ExxonMobil. This is the biggest loser in the portfolio right now. But given the political stuff with oil, given the travel ban, and the negative price of oil, like it's just been a ride. But keep in mind, guys, that's why I picked it. I knew there was going to be like regulation issues, political issues. It's a commodity. It fluctuates, right? So that's the reason why I picked the reason I picked Exxon over Chevron is because I like the dividend better. But I do really enjoy the fluctuation because that gives me better buying opportunities. So before, it was sitting at like $70, right? That was like my first tranche, or my first buy of Exxon was, I think, about the $73 range. Then I bought again in the 60s. Then I bought again in the 50s. And now I have a chance to buy in the 30s. So if I was working right now, this would be the stock I'd be pouring money into, because I can cost down average and almost cut my cost in half. And then my dividend goes up and I lock in a higher yield as well. So I'm down about 15. Oh, sorry, I have eight. Sorry, I shouldn't jump like that. I have 84 shares, about $2,900 of market value. Average cost is 53.20. About 14% of the portfolio is in ExxonMobil. We're up on the day, but we're down almost $1,600, down 35% on ExxonMobil. And again, I'm not worried about that. My first big purchase was at 70. Then I did it again at like 50, around 53. Because that's my average cost. So I've been cost down averaging, and big fluctuations is the literal point why I bought ExxonMobil. So I'm happy about that. This is just an opportunity. I'm just ticked that I can't take advantage because I'm not working right now. Next, we have Walgreens. Dividend Aristocrat. We have 6 shares, $225.96 market value. Average cost is $39.92. 1.09% of the portfolio is in Walgreens. We're down 13.53, down 5.65% in Walgreens. Then we have Aflac, only a single share. I wanted to get into the insurance business. I looked into a lot of other options. I looked into MetLife, Allstate. Just there was a few. There's about 5. I looked at Travelers too. Um, and I liked Aflac the best. So I have 1 share, 37.34 is our market value. Average cost is 35.75. 0.18% of the portfolio is in Aflac. We only have 1 share. This is my goal stock. This is my goal stock for this set of months. It's a stock that I want to reinvest dividends into. But right now, Exxon is just way too good to pass up. So I have to pick Exxon. Otherwise, I go nuts. I can't pass up that opportunity. But um, that closes out the portfolio. Just so I don't do it again, because PBCT and ABBV need to switch, because I'm used to having ABBV behind Target, and they're the same status. Um, so for the portfolio, the buys that I'm the most excited about right now are Altria, AT&T, and ExxonMobil, and those are my 3 biggest positions. So I'm trying to diversify and kind of lower my percentage allocated towards those specific companies, but they're just too good to pass up right now. But then jumping down to the watch list, starting off with my own personal bank, U.S. Bank at 39.20. I think it's a buy. I'm about 20, well, about $15 to $17 of upside in the stock. Um, Actually, no, I do have 20. Sorry, I thought it was, yeah. So it's $61. So I have $20 up in upside in the stock, which I look for about 15. So that's enough for me. Plus, it does have a 41-cent dividend, which I have not heard about any cuts or any issues with U.S. Bank dividend wise. So I would be comfortable putting money into it, and it's only about 4K to be dividend efficient, which isn't terrible. That's a straight year of investing, less than that if I use dividends to do so. But I would like to have my actual banking institution in my portfolio. Next, we have Pepsi Cola at 141. I'm not touching it because I don't have enough upside in the stock. Then we have Kimberly Clark at 154. Only $6 of upside. Not enough, not even close to enough for me. Then this is the switch that I made. So I got rid of Starbucks because they don't have status. I do like the dividend growth, but I just think Northwest Natural is a better pick for the portfolio and my goals. So it's at 46.49 with a $77 52-week high. So $30 of upside per share plus a growing dividend. They are aristocrat status. So it has the status over Starbucks. That's why I picked it. And the thing is, guys, I'm not a fan of coffee, but people need water and gas and water. Like it's needed. I actually looked into other water utilities, and the dividends just weren't there enough for me. They had the dividend growth history, but the current payout just was a snooze fest. So I'm happy that I found Northwest Natural. I actually saw it on Instagram. I'd never heard of it before. Um, but I'm happy I found it, and I'm definitely going to be adding it to the portfolio. Next, we have Colgate, Dividend King. Not enough upside to buy it, though. Procter & Gamble at 143, not enough upside to buy it. Essex Property Trust at 300 is a steal. At $300, we have $34 in the stock, so I'd actually buy it at like 312 or 315. So that's $100, $110 of upside on the current price, where I think it would be reasonable to buy it. So this is a steal on the watch list, an absolute steal, and this helps me be more allocated towards my favorite. My goal really is to get into real estate one day, and the thing is, real estate investment trusts are a very easy way to actually get exposure to real estate because generally where I live, down payments of like 20% are about 20K. So it's about what I have in the portfolio, but I don't need to put 20K down to own the assets of SX Property or Realty Income or McDonald's or public storage. None. I don't need that money saved up. I can just spend $200 on it and get a portion of the business, and then it pays me passively through rent. And the regulation of utilities, they have to, or excuse me, regulation of REITs, they have to pay 90% of their earnings to their shareholders. So it's like I get that locked in due to that, the legal, like the rules of REITs legally have to pay you 90%. So I have that dividend. It's a dividend aristocrat, and it helps me with the allocation towards my goal for real estate in my portfolio. Next, we have Black Hills. This was the only utility play, but since I added Northwestern today, it's not. But I do really like the company. They're close to Dividend King status, and at 58, I think they're a steal. Next, McDonald's. This helps me with my diversification, and it helps me in real estate. So I want real estate to be about 20% of the portfolio. But of course, I'm not going to be super overly invested in a single one, but I can tell you that there are certain ones that are going to get allocated towards more than others. McDonald's is number two for me. Um, but at 230, not enough upside in the stock. That actually is a 52-week high. Yeah, they messed that up because look, 229.48 is less than 230. So it hit a new 52-week high according to the stats. um, then we have PSA at 234, 246, about $10, $12 of upside. I'd need it down to about the 228 to 229 range just for that $15 of upside per share. I'd like it lower than that, so I'd probably hold off on buying it. But as for the real estate stocks, first Realty Income would be the number one. Um, then I would say um, it'd be Realty Income for sure. Definitely my number one pick. Here I'm gonna look real quick because sorry, I'm drawing a blank. Realty Income is by far my favorite one. And then it would probably have to be FRT because of the status. Then next would be SX Prop, or sorry, then would be McDonald's, then would be SX Property Group, and then would be PSA. So it would, for real estate, it would go O, FRT due to the status, then Mickey D's, then SX Property, then PSA. But then, guys, we have the for my real estate allocation. But then we have our growth stocks with one of my personal favorites. Honestly, probably my favorite stock to be in my portfolio. Um, just in general, I'm an Apple fan. 121 bucks, about what, 15 $16 of upside, so just enough upside to get into it. But I love their product line. I love their CEO. There's so many things that I love about Apple as a company. But my number one thing the reason that I want to invest in it is the growing services portion of the business, because I don't think a lot of people talk about that, but that's an insanely profitable portion of their business. I know everybody's worried about iPhone and how much of their profit they're dependent on, but the thing is, that's really okay. That's a big seller. It's not their fault. That's a good thing that a product is that popular. But um, I think the services will actually grow and someday be um, the second biggest revenue maker for the company. Then we have my second growth stock in Disney. And you don't need too much explanation. Disney's in the lives of every child. Every kid wants to go to Disneyland. Every kid has a movie come into your head when you snap and you say Disney. Something popped in your head, right? For me, it's Lion King. Um, for my favorite Disney movies, it goes Lion King, then Tarzan, then Oliver and Company. Then I'd probably have to give it to Aladdin, and then The Jungle Book. But Disney is just ingrained in our culture. It's ingrained in us, since we were kids. And at 127, I have about 20 more than $20 of upside. So I'm definitely buying Disney here. And I'm honestly, it's one of those that I'm a fan of. I've been a fan of it since I was like 2 years old. So Disney in the portfolio is kind of Apple and Disney to me both are no brainers. Regardless of if Disney is paying a dividend, they did pay an 88-cent dividend. And my original motivation behind it was I wanted Disney to I wanted the semi-annual dividend, so it pays twice a year, or did pay twice a year, 88 cents. I wanted to have enough cash in Disney to actually pay for my Disney subscription all year. Funny thing is, Altria actually almost pays me enough. Or actually, yeah, um, Altria, the first month of the year pays for my Disney Plus subscription now. So I did achieve that goal. I just didn't do it with Disney stock. But, anyways, guys, that rounds up the portfolio. So the stocks that I would buy within the portfolio that I want to be focused on are CocaCola, AT&T, and Aflac. But right now, I would actually switch out Coca-Cola for Altria just because it's down, and I got to take advantage of it. Or actually, FRT should be the focus because it's the biggest. It's the most down in the bunch for the stocks within the portfolio. So FRT, AT&T, and ExxonMobil are the ones that I would be buying right now. Then for the watch list, for the first set of months, definitely U.S. Bank. For the second, it's SX Property. But Northwest Natural is going to be a pretty big staple in the portfolio as well. And then of course, no brainer for Black Hills, and both Disney and Apple. I would love to own them in the portfolio, and I think they're good buys right now. So, anyways, guys, that rounds up the portfolio. Thank you guys so much for watching. Remember to hit the subscribe button on my YouTube channel, and when you do, hit the bell notification. Guys, I try to post consistently every Monday through Friday. I might get a couple videos out on the weekends. I kind of slack off on the weekends because I'm so dedicated to my Monday through Friday. So you guys can, unless I have something medical come up or it's like a birthday or a family holiday or something like that, I will always get a video out Monday through Friday. Um, and want that consistency out of my YouTube channel. I see such good growth when I post like 2 or 3 videos a day. And I do want to get back to that because I do have some dividend updates that I want to cover. I plan on getting those done on Friday. And there should be, I think there was like 4 the last time I checked, so there's probably like 5 or 6 hopefully by the weekend. There'll be some more that I can cover, so that way I can kind of sprinkle those out throughout the week. So I'll give you guys more content. Um, that's the plan anyway. But anyways, guys, hit the subscribe button. I'll see you guys tomorrow with another Robinhood portfolio update. Thank you so much for watching, and I'll see you then.